Greetings and thank you for joining us. My name is Dave Yeski, and I'm looking forward to spending the next 40 or 50 minutes with you talking about the world that was and the world to come, and hopefully getting some questions and comments from you along the way. Speaking of which, um, uh, take a moment to note that there is a place for you to type in questions or comments that you may have. And I'm being assisted by Yusuf Abujaderi in this broadcast, and he will make sure that if I miss it, it's brought to my attention, and we'll try and address, everything you want to talk about over the course of the next hour or so. So let's just begin with a brief overview of what we're going to be covering. We're going to be talking about the economy and the markets last year, what evolved and where it came from, what it looked like by the end of the year. We're going to do our best to look forward into the coming year and think about what may be coming down the road. We're going to be talking about what the implications of an election year are. We'll look at the global landscape as always. We'll look at what's happening in the U.S., but we also want to be cognizant of what's happening all around the world because it's a very interconnected world, and events far from home still have an impact on us and on our finances. And finally, we'll talk a little bit about what we can do as individuals in order to be best prepared for the unfolding reality. So, if we look back over the past year, the U.S. and global economy continued to grow. We've been on a growth path for some years now. We've been on a growth path for a decade. Ever since the end of the Great Recession, the U.S. has had steady, if not always spectacular growth, typically in the 2 to 3% range, a few times slipping below 2%. Well, growth continued last year, but it did so at a declining rate. And that was due to a number of headwinds that we'll talk about later. There were some, speaking of headwinds, one of the major headwinds we've had actually for the last 3 years have been trade tensions that have been quite ramped up between the U.S. and many of our trading partners. There have been a few positive developments on that front. Most specifically, a new agreement that was just signed today with China, between the United States and China, which we hope will have a positive impact. The Fed began last year, actually, I'm going to say just a tad before that, at the end of 2018, Fed Chairman Jay Powell made clear that the Federal Reserve was not going to be influenced unduly by stock market signals and other things, that they were going to be on a path of probably increasing rates at least 3 more times in 2019. Well, so much for predictions, even from top economists. It turned out that the Fed not only didn't increase rates 3 times last year, the Fed decreased rates 3 times last year. And that was as a consequence of some perceived new weaknesses most especially in the global trading system. That, again, trade frictions had been putting a damper on global growth, not just U.S. but global growth for several years now, and that those trends continued and actually worsened. And so the Fed was concerned about the impact, most especially on the United States economy, and so they ended up making a major U-turn and becoming much more cautious. And all indications at the moment are that they're going to continue to be cautious. In terms of the geopolitical scene, we had rising tensions in the Mideast. Tensions have been rising between the United States and Iran for the last 3 years. Not that relations have been good for 30 or 40 years, but they've certainly been worsening in the last 3 years. And late last year, we had some missile attacks that killed a U.S. contractor, that raised tensions. And then, of course, this wasn't in 2019. This was January 3rd of this year. The U.S. killed General Soleimani, the Iranian general who's responsible for much of Iran's military adventuring around the Middle East. And that created a major spike in tensions, and in fact resulted in a missile attack on 2 Iraqi bases that house quite a few U.S. troops. Fortunately, no U.S. troops were killed during those, or even injured. I don't believe, um, but it looked like we were headed for a major escalation, and then all sides kind of stepped back. And so we'll have to see where that goes. But it doesn't seem like it certainly is not in anyone's interest for the conflict between the U.S. and Iran to escalate beyond where it is at the moment. So that will be something for us to watch going forward as well. So now let's turn specifically to the stock markets. So I don't think you can really talk about the stock or even think about the stock market behavior and performance in 2019 without beginning the year before, because 2018 ended on quite a dramatic move. The markets were down in December by almost 20%, 19.8% from the high point earlier in the year, and was down 18% just within the final quarter of the year alone. This was a very, so as you can see from this chart, it was a very precipitous drop, and it was, as always, these kinds of when markets move on a dime like this, it's because there's been a shift in sentiment, where suddenly the consensus of investors takes a major U-turn, and investors suddenly, the consensus turned very negative. Typically, there's no economic theory for this, but in general parlance, people talk about a bear market as being marked by a 20% decline in the stock market. So, by that definition, we basically moved from a bull market into a bear market, and obviously things were looking very bad. And it was shortly thereafter, it was in the first couple of days of January of 2019, when Fed Chairman Jay Powell, as I mentioned earlier, did an about face and said, no, actually the Fed was going to be paying attention to market signals, and they began loosening. And as I said, they actually lowered rates 3 times over the course of the year, which led to this kind of behavior. This is the global stock market. This is the MSCI All Country World Index, which is one of the broadest measures of the global stock market that you can use. And I think it's pretty easy to see that with some choppiness along the way, nonetheless, the general trend was up. And in fact, as I'll note in a moment, it was up over 20%. Interestingly, those of you who follow our work here at Yeski Buoy know that we like to talk about the fact that in the short run, movements in the market are really driven by the daily news cycle, which is to say they're dominated by the noise. And so I wanted to take this opportunity to just give one more example of the many we've given in the past of how, if you look at a window, if you look at the market behavior through a window that's 3 months or 6 months or 12 months wide, what you're seeing is really dominated by that noise. Here's an example. This is the middle 6 months of last year, from March through September, and you can see that there was a lot of up and down movement, and it basically went nowhere. So if you looked at the middle 6 months of last year, you'd say, well, nothing's happening here except for a lot of volatility. The market's rising, it's falling, it's trending up, it's trending down, but nothing's really happening. You really have to widen it further, and 12 months is by itself often not enough. But in this case, if you widen it by if you widen your window of view to 12 months, you'd see that through all of those ups and downs and that seeming stasis through the middle of the year, we in fact globally achieved nearly a 25% return in the markets. Here in the U.S., the S&P 500 was up about 30%. The Dow Jones Industrial Average about 22%. So depending on which slice of the market you look at, the performance was a little different, and we'll actually burrow into that momentarily. But nonetheless, it was by all measures, it was a good year in the markets. Whether you were looking at the U.S. market, whether you're looking at the markets globally, you were looking at a very good year in the markets, even though there were various points along the way when you really wouldn't have predicted that was the case. Now, if we break it down further, um, again, as those of you who have followed our work and our thinking in the past, you know that we think in terms of market factors where there's reason to believe that there are attractive returns to be had, that there's sort of a deep underlying economic driver, something we'll talk about more in a few minutes. But these categories represent various slices of the market that are meant to maximize some of those factors, specifically small company and value stocks, including small value and as well as large value and so forth. And what you can see is that um, international value was up over 16%. Emerging markets were up over 16%. By almost any measure, that's a good year, right? Anytime markets are in the double digits, we think it's we should assume it's a good year. Um, but when we move into the U.S. small value stocks, they were up even more, nearly 18%. International small value was up over 20%. The micro cap uh, stocks in the U.S. So these are not just small company stocks. One measure of small company stocks, one broad measure is you could rank stocks, all the stocks in the market by size from the largest to the smallest, and you could look at the bottom half and say, okay, these are the small company stocks, and the top half are the large company stocks. This particular measure, and you can see this says DFA, that stands for Dimensional Fund Advisors. Uh, what I've what we've chosen to do is to illustrate these particular market segments using the investment vehicles that we pull together when we're building client portfolios. Anyway, this microcap slice of the market is not just the bottom half, it's the bottom 1/5 of the market. So the bottom 20% of the market by size. So these are very small stocks, and they were up 22%. Um, International stocks broadly, this is like international blue chip stocks, were up 23%. International small company stocks, speaking broadly, were up over 23, almost 24%. And U.S. large value, up more than 25%. Global real estate was a big winner and has been for the all of last year. It was doing very well, and it was up 27%. And finally, the S&P 500, kind of a broad measure of U.S. blue chip stocks, kind of dominated by the the large growth stocks, and really dominated by technology stocks. It was up 32%. So even this is kind of an interesting example of the virtues of diversification, because when markets are, we had a time back during the Great Recession as one example where pretty much every stock market segment was down, but they weren't down by the same amount. So you were better off if you were diversified, unless you were lucky enough to have picked the one segment that was down the least. In general, since you can't know in advance which one is going to be down the least, by buying all of those segments, you know that you're not going to do as bad as the worst. That you're going to average that result out. And you see the same thing on the upside. Even when markets generally across the globe and across different market segments, even when all market segments are rising, they rise by different amounts. And because we never know in advance which of those segments is going to be the one to be the top performer, we want to invest across those segments. So it was a good year for all segments. Everything was up in the teens. Everything was up basically 16% or more, but it was especially good for large growth stocks. And the last thing I'll say about the S&P 500 is it's not only currently dominated by growth stocks, but as I mentioned, it's very dominated by technology stocks. We talk about the FANG stocks, the Facebook, Netflix, Apple, Google. These are Amazon. These stocks have really dominated the S&P 500, and because the S&P 500 is what's known as market weighted, where each company's share of the index is proportional to its market valuation relative to the other companies in the index. So as these behemoth technology stocks have grown, have had a big run in recent years, they've really kind of taken over the index. So the S&P 500 has become a very tech-heavy index, and that's something probably to be a little concerned about. One needs to know if you buy the S&P 500, you're making a bit of a bet on technology, whether you knew it or not. All right, so let's now talk about. Let's take a let's take an about face and let's look forward. We've looked back. We've kind of seen where we ended in 2018 and where we went over the course of 2019. Let's now think about 2020 and beyond. Obviously, the first thing I'm going to say, and those of you who know me were waiting for this, fundamentally, the future is unpredictable. So I'm going to tell you right up front, I don't have a crystal ball. At least I don't have a working crystal ball. Mine is very cloudy. And nobody has a crystal ball. The future has yet to be written. The world is a complex and chaotic place, and the way in which events unfold is not predictable. And that should be our starting proposition. If anyone tells you that they know what's going to happen in the economy or the markets or frankly, in any other realm of life in the future, you need to walk away because that person is either a charlatan or certifiable. So let's start with that fundamental proposition that the future is unpredictable. So where do we go from there? Well, we look for deep regularities. Again, those of you, who have spent time talking to me or to any of us here at Yeski Buoy in the past, you know that we talk about the economy and the markets as being kind of like the weather. Why is it like the weather? Well, it's because it's a complex adaptive system and it's fundamentally chaotic. Meteorology is a real science, and meteorologists are real scientists. And yet they struggle to make even short-term predictions about the weather, especially short-term predictions about the weather, because of the fact that you would have to be able to track all of the uncounted trillions of molecules in the land and the sea and the air in real time in order to know what the net effect was going to be on the weather. And that's just beyond the power of all the supercomputers on the face of the earth. But it doesn't mean that there aren't deep regularities in the weather. And I'm not talking about climate change, but I could be talking about climate change. But in general, for example, there are deep regularities in terms of any given region's long-run rainfall. So if you were to ask me today, how much rainfall do you think we're going to have in the next 12 months? My first answer would be, I don't know, and it's unknowable. But my second answer, if I was going to try and humor you, would be to offer up the long-run average rainfall for whatever region we're in. And I'm currently sitting in San Francisco, so Northern California, I'd offer the long-range average rainfall. In the next 12 months, that won't be the number. It'll be higher than that or lower than that. But with each passing year, the cumulative rainfall will begin to converge on that long run average. So if I was a water manager, for example, if for a city or a region, I could think about creating reservoirs that would bridge any downturn in rainfall based on the long run averages. Well, we can do some of the same things when we look at the economy and the markets because there are deep regularities. One of those is that over the long run, stocks have higher returns than bonds. Another one is that over the long run, small company stocks have higher returns than large company stocks, and value stocks, which are those that trade at a low price relative to their earnings or their assets, have a higher return than growth stocks or than the market as a whole. And there are reasons for this. There are underlying, and this would be a whole hour unto itself, so I'm not going to go there right now, although I'm happy to if anyone wants to reach out to me offline. I can't go to the underlying economic mechanisms, but there are underlying economic mechanisms that we can point to that we believe are persistent. So this is not just like an artifact that came from data mining. There are deep underlying economic mechanisms that we believe will persist into the future that will continue to cause these regularities to emerge. Not predictably, as in it's going to be, small company stocks are going to beat large every year. They don't. Or that value stocks will beat will beat growth stocks every year. They don't, but they have a propensity to. So it's like in any given year, you have, I think that I should have the number at my fingertips, but I think the number is a 55 or 60% probability that value stocks will do better than growth. So that means that 40% of the time, growth stocks do better than value. But if you're going to play the odds, what will you do? Well, you'll tilt towards value stocks because, I mean, if you went to a casino and you had an even 51% chance of a particular outcome, you could make out like a bandit. So this is a case where it's not predictable in the short run, but it's a long run regularity that we try and harness. The other thing we look to is and I'm going to have some graphical illustrations of this momentarily, is the fact that global markets tend to trade leadership periodically. That you can assume that while the U.S. may dominate foreign markets in any given period, that trend will reverse itself. And finally, building resilience will always pay off. Diversification is something that always has a beneficial impact on your portfolio. Broad global diversification, and also just building resilience in your portfolio through having adequate cash and bond reserves. So let's look at this measure. This is just to illustrate some of those deep regularities. This chart shows the cumulative growth over the last 26 years of the MSCI All Country World Index. That's the index I mentioned. I illustrated earlier. That's the light green at the bottom. That's the cumulative return. And then the dark area represents the cumulative growth of all of our Yeski Buoy portfolios in the aggregate. And that's the only way we measure and report them is the composite return for all portfolios mushed together. And one of the things you'll see is that over the last 26 years, the cumulative growth to our portfolios collectively has been greater than the cumulative growth of the All Country World Index. And there's a reason for that. The All Country World Index is a market-weighted index, which means it's kind of dominated by larger company stocks. Because large company stocks, both in the U.S. and outside the U.S., make up about 90% of the value of the stock market. And small company stocks make up about 10% of the value. So as a consequence, if you have a neutral index like this, or for that matter, the S&P 500, small company stocks only make up about 10% of the index, and large company stocks 90%. Well, we very consciously tilt our portfolios towards small company stocks. So we own a lot more than 10%. We also buy more value stocks than is their natural share of the market. And so when you look at a difference, what accounts for that difference are those decisions to overweight small company stocks and overweight value stocks. So you can see that, many studies go back to 1926 and even earlier looking at these factors, but even in our own client portfolios over the last quarter of a century, we can see how this propensity, this deep underlying regularity has tended to emerge. Now, this is a measure this shows the relative dominance between U.S. markets and overseas markets. And the way in which this was constructed was, this represents a rolling 12-month average returns in which the return to the S&P 500, in which we subtracted, maybe let me put it another way, in which we subtracted the returns to an overseas index. In this case, it's called the EFA, which is an acronym for Europe, Australasia, and the Far East. We subtract the returns to overseas markets from the returns to the S&P 500. And what that results in is if the S&P 500 had a higher return, doesn't mean that either of them had a negative return, but if the S&P 500 had a higher return than overseas markets, when you subtract the returns to overseas markets, you're left with a positive number, and so you get a bar on top. If returns to overseas markets were higher than the S&P 500, you end up with a negative number, and you get a bar on the bottom. So whenever we see bars on top, it means that the U.S. is doing better than overseas markets. And when we see bars on the bottom, it means overseas markets are doing better than U.S. markets. Well, over the last 10 years, the U.S. market has tended to do better than overseas markets. Not every 12-month rolling period. You know, if, over a 10-year period, you have 120 months in which you could measure the 12-month rolling return, which is what this represents. And in this last 120 months, the U.S. Did better than overseas markets in all but 25 of those rolling 12-month periods. However, it's worth noting that for the 10 years preceding that, overseas markets consistently did much, much better than U.S. markets. So you can see how, if you go further back on this chart, you could see how they regularly would alternate leadership. And again, a bar on the top or the bottom doesn't mean that one market was positive and one market was negative. It just means that one market did better than the other. So this is all a relative measure. But anyway, coming up to 2010, if you were standing in 2010 looking backwards, you'd be asking yourself why you'd ever want to invest in the U.S., since all the actions seem to have been overseas. Obviously, that just shows you how inappropriate it is to engage in simple extrapolation, because in 2010, having seen the U.S. market be basically, as measured by the S&P 500, actually was flat for 10 years. You know, I know this was 10 years ago, but if you think back, you may recall that in 2010, there were a lot of news articles and headlines about the so-called lost decade, because the S&P 500 was at the same price level as it had been at the beginning of the 2000s. And so it had produced some dividends, so it wasn't entirely lost, but it was basically flat for that 10-year period, lost decade. Now, what you can see from this chart is that it wasn't a lost decade if you were a global investor. Your portfolio actually had positive returns because overseas markets were doing so well. And actually, even in the U.S., small company stocks and value stocks were doing well also. But this is the thing. There's a thing called mean reversion, which means that if something's doing worse than it typically does, at some point it's going to do better. And if something's doing better than it typically does, at some point it will do worse. And so we expect things to trade leadership. They don't. It doesn't always take a 10-year period to see this happen, but sometimes it does. As you can see, between 2000 and 2010, overseas markets did better for an entire decade. Between 2010 and the present, U.S. markets did better for a decade. What's going to happen this coming year? What's going to happen over the next decade? Who knows? But odds are we're going to see another inversion. And part of the reason for that is that things, this whole notion of mean reversion is that things tend to go beyond their natural limits. For example, in the long run, the S&P 500 tends to have a price to earnings ratio, which is a measure of how expensive stocks are, at least those 500 stocks. The long run average is about 16. So for every dollar of earnings, investors on average over the long run would pay $16 to buy a dollar of earnings. Well, right now, it's at 25. So that doesn't mean it's about to fall. That doesn't mean it's about to crash, but it does mean that it's well above its long run average, and odds are that's going to correct itself at some point. Meanwhile, if you look at overseas markets, their price to earnings ratios almost universally are down in the teens and are below the long run average, or at least maybe at most at the long run average. So there's also a lot more upside there. Okay, now let's move on to what I know you were really looking for, as a discussion of what happens during an election year. And these are all presidential elections, as you can see by looking at the vertical axis on the left. And what it shows is the returns to, and this is as measured by the S&P 500, the returns to the U.S. market during an election year. That's in gray. That's the gray bar. And in the year following an election year, and that's the green bar. You can see that actually, interestingly, if you just glance at this, you would conclude perhaps that not only does the market tend to go up in every election year, but it tends to go up by even more in the year following an election. And this is international markets, also keyed to U.S. presidential elections. And yet again, you can see here a very strong propensity, especially in the year following an election, to see very strong returns in the market. Now, I have to say, I now have to reveal the dirty little secret behind this illustration, and that is that the reason it looks like markets tend to go up in an election year, and the reason that it looks like markets tend to go up in the year following an election year, is because in general, markets tend to go up. Markets go up by much more often than they go down. So if markets go up much more often than they go down, then the odds are in any given year, the market is likely to be up, which makes an election year and a year following an election year in some ways like any other year. The probability is the markets are going to go up. So it's easy to look at charts like this and draw lots of conclusions when in reality, it's masking where this is in fact masking a larger reality. Here's here are all the presidencies marked out on a chart showing the growth of the market since 1926. And as you can see, there have been a few periods like through the 70s in the Nixon Ford period when things were kind of flat, but in general the markets go up. And so in general that's our expectation. Again, if you're playing the odds, that's how you have to think. It's why it's why we can look at these things and be interested, but we shouldn't change our actual policies when it comes to how we save and how we invest. So let's take just a moment to now look at some of the headwinds that we can identify as we look forward. So I'm sure there's no one who's not in a coma who doesn't know that U.S. impeachment proceedings are about to begin. The House, as of this morning, has named 7 managers of the House case that will be making in the Senate. And this afternoon, if it hasn't already happened, any minute now, representatives of the House are going to be walking through the rotunda and delivering articles of impeachment to the Senate. The last I saw, Mitch McConnell, the Senate leader, said that the Senate would begin its proceedings next week. So this is no small event. There's only been 3 times in history when a U.S. president has been impeached, and so this is a significant event. We can all place odds on what's going to happen. I mean, all the odds makers are basically saying that eventually it's going to be dismissed in the Senate. Certainly that's the way the political winds are blowing. But nonetheless, it's a big event, and it has and will continue to have an impact on our perceptions of the world around us, including the economy and the markets. We don't know what that impact is going to be, but it'll be something to watch. And it's also a presidential election year. And that obviously throws a lot of uncertainty into the mix. Markets are always forward-looking. And policymakers around the world are also forward-looking. So, you could say, well, President Trump is going to be president. Well, I mean, unless he's convicted in the Senate. Again, pretty much everyone agrees that's unlikely. He's president this year, and his policies will be the policies this year. But individuals in the U.S. and outside the U.S., including most especially investors in the market, they're looking forward. They're saying, okay, well, depending on the results of the November election, we don't know what the policy is going to look like next year and the years thereafter, and that could have a big impact on the economy. There's been a rapprochement with China, but we're not sure how positive that's going to be. President Trump actually signed an agreement again today. Today's been a very momentous day for the news cycle. Signed an agreement, a trade deal, or at least a preliminary trade deal was agreed to back in mid-December, and that initial agreement has now been signed by the Vice Premier of China and President Trump today, and it doesn't remove any tariffs, which is unfortunate because notwithstanding some of the misinformation that's been spread, tariffs are not paid by foreign countries or foreign manufacturers or uh, or anyone outside the U.S. Tariffs are paid by U.S. importers, and then thereby tariffs are paid by U.S. consumers. And so it tends to damage business. It reduces business investment within the U.S. It raises prices for U.S. consumers. It's not good for the economy. It's not good for anyone. And it's not that the U.S. shouldn't be policing global trade practices. It's just that this is a blunt instrument that probably has more negative consequences than positive when it's being used as a cudgel in a trade battle. So the tariffs remain, and that will remain a headwind. Uh, Perhaps no new tariffs, perhaps a little more stability, or at least a little more predictability. That could be a positive. But but companies both within the U.S. and inside of China and everywhere else around the world have already, as a consequence of 3 years of trade friction between the U.S. and China, have begun to restructure their supply chains. And as a result, there's been a bit of a decoupling between the U.S. and China. And there's also been, in general, there's been a depression in global trade overall, not just between U.S. and China, but global trade has been depressed across all countries and all regions. And it's one of the reasons that we've had started that for 3 years. We've seen steadily declining growth rates in the U.S. and global economy. And in fact, here's a measure. Um, the International Monetary Fund reports that global growth across different countries and regions slowed last year, not by a huge amount. I mean, growth in the U.S. Fell from 2.5% in 2018 to about 2.1% last year. So it was a fraction of a percent, but when you're only growing by 2 to 3%, a half a percent or 0.4% of a percent is a non-trivial amount. So that's going to continue to be a headwind. And on a forward-looking basis, the World Bank and the International Monetary Fund and others that look at the global economy expect continued trade issues, and expect that to continue to be a bit of a headwind. So where does that leave us? One last thing I was going to mention was, of course, Brexit. This has been in the news ever since June of 2016. That's when that original referendum was passed, or was put out to the public by Theresa May, and of course there's been turmoil ever since. Um, Boris Johnson has, in the last general election just held, managed to achieve a significant conservative majority in Parliament, and so there is now a Brexit agreement that has been renegotiated. It's expected to go into effect January 31, so the 31st of this month, and then play out. There's some various adjustments that will take place all throughout the year, and then a final agreement will be settled on December 31. So that has already had an impact on growth within the UK. It's had its own impact on global trade, and we'll just have to watch it. And we'll have to see what impact that has as this year unfolds and Brexit becomes an absolute reality. Okay, so now let's come forward and bring that to where we are, what we can do about it. And we always come back to the same message here. So those of us who know us, you're not going to be surprised to hear this. We need to focus on the deep regularities, and we need to control what we can control. So let's begin with the deep regularities. When we describe our worldview, we think that every approach to giving advice needs to be deeply grounded in a consistent worldview. A worldview is a set of beliefs about how the world works. We talk about evidence-based financial planning because we strive to be evidence-based in everything. So when we think about how the world works, we're looking for deep regularities that can be identified that we believe are going to persist. Well, there's no deeper regularity than human nature. Human nature is the consequence of millions of years of evolution. And it's going to take millions of years more before human nature is going to evolve into something different. And so none of us on this webinar are going to have to worry about that. So human nature is a deep regularity that is going to persist over time. One of the most fundamental natures about human beings, one of the most fundamental aspects of human nature, is that human beings are growth seeking and resilient. Human beings are constantly trying to make their lives better and make the lives of their loved ones and their family better. And in so doing, they tend to be ingenious and resilient. Human beings, you know, get human beings get thrown curveballs all the time, and they adapt. They change their behavior, they adapt, they try new strategies. They're constantly working to improve their lives and the lives of those they love. And so that means that the economy must fundamentally be growth oriented and resilient. Why? Well, the reason is that the economy is nothing more than you and your family and your friends and everyone you know and everyone you don't know going about the business of earning, saving, spending, and investing. And all those individual actions aggregate up to the economy. So the economy is just human beings writ large. It's just the aggregate behavior of you and all of and everyone you know and everyone else you don't know. And so if we are individually growth seeking and ingenious and resilient, then in the aggregate, we, the economy, must be growth seeking and resilient. And therefore, the stock markets, which are merely a reflection of what I'll call the real economy, they just represent ownership of the productive assets of the economy. That must also be growth oriented and resilient. And we see that. You saw that in the chart a few minutes ago, in which I showed the growth in the U.S. market from 1926 to the present. Happened to be marked out by presidential terms, but it doesn't matter. The point is that through all the ups and downs, it tends to grow. We're not going to, I don't want to minimize the ups and downs. I mean, the world's a chaotic place. We get thrown curveballs all the time as individuals, as companies, as nations. We get thrown curveballs, but we tend to overcome them. So we have the inevitable dips, the inevitable decline and retrenchment, and then followed by the resumption of growth. So as individuals, that leaves us then seeking to control what we can control. And it's very, it reminds me of the Serenity Prayer. This whole notion of controlling what we can control is very important in financial planning and planning our personal finances. So first and foremost, since we can't predict the future, we have to build resilience into our lives. We have to be able to weather whatever comes along. And so the ways in which we do that is, first of all, we make sure we have adequate cash and other reserves. If you're actively involved, if you're working and you're in the midst of your career and maybe retirement is many years away, you still need to have an emergency fund. You still need to have adequate cash reserves in order to deal with the unexpected. The unexpected could be that you had some loss that might still be insured but subject to a deductible. Well, how are you going to come up with that deductible? You wreck your car, the insurance company will pay to replace it, but only after you give them $1,000. The same applies across the board. Or for that matter, there could be an interruption in your income. The thing about emergency funds is that a lot of people say, well, you should have 3 months worth of spending needs in liquid reserves, in cash reserves. Well, that's not a bad starting point, but it really is just a starting point. It needs to be adjusted for individual circumstances. I've had clients in the past whose income was so highly variable, they might make a huge amount of money one year and no money the next. Now, over time, over the long run, they had a nice average income. But in the short run, it was highly variable. And so this person actually needed a year's worth of reserves. Other people who have steady jobs and high job security, maybe they do only need 1 or 2 or 3 months worth of reserves. But based on your circumstances, make sure you have some cash reserves. It will give you flexibility. It will allow you to weather the unexpected. And if you're retired, then it's important to also have a larger stable reserve. In our portfolios, we construct this with short-term, high-quality bonds. and it becomes a source of spending during a downturn in the economy and the stock market. In that case, we actually, for those who are retired, we like to have 6 or 7 years worth of spending in a stable reserve. We think that, well, it's a bit of a judgment call. We think that that's an adequate window to carry you through any expected downturn in the economy and the markets. It's important to be broadly diversified. We saw that in the earlier chart where you can see how the performance of different stock markets and different segments within the market will vary greatly from one year to the next. And so the only way to build resilience is to diversify across the globe and across all those market segments. It's also good to have good saving and spending habits. Or maybe I should say good spending and saving habits, because good spending habits is what leads to good saving habits. A good friend of ours, Dick Wagner, who was a great philosopher within the financial planning profession, used to say that, the simplest policy you could possibly have is spend less, save more, and don't do anything stupid. And those are words to live by. But having some knowledge and awareness of your spending, having some control over it. Cash flow is a key driver with almost every financial plan that we work on at Yeskibui. And so we know the importance of having some awareness and some control over your spending. And if you're not retired, you also need to be saving. I meet very few people who have so much in the form of financial wealth that they don't have to save from their earnings. Most people need to be saving during their earning years. And it's important to regularly review your finances. We talk about financial planning as taking place in two realms. And the first of them we like to refer to as the realm of financial hygiene. And financial hygiene involves looking at those things, those gaps in your financial affairs that can be identified and addressed in the moment. Maybe you have inadequate homeowners insurance, or maybe you lack a renter's policy. Maybe you have inadequate auto insurance, or you need an umbrella liability policy. Maybe you don't have enough cash reserves. If you're employed, are you maximizing the use of your employee benefits? And finally, with your estate plan, your will or your living trust, you need to go back and review that periodically. Ideally, every year you should look at it and make sure that the provisions you've put in there are still sound. Make sure that the people you want to benefit have not changed. Make sure, just as importantly, that the people you have named to carry out your wishes are still the right people. Who have you named as your executor? Who have you named as your successor trustee? Make sure that continues to be the person you trust to carry out your wishes. Make sure you've accounted for all your loved ones. Make sure you've accounted for the organizations, the charities that you may care about. These things change over time. They change because people's lives change. They change because the world changes, and they change because your desires change. So this, among many different aspects of your finances, your general finances, need to be reviewed and examined periodically. That's another way you maintain resilience, is by actually having knowledge of what's in your finances and what's in your financial plan, and making sure it's always as it should be based on today's circumstances. So, having covered all of that in just shy of 50 minutes, I'm going to pause and say that I haven't seen any questions yet, but this is most of what we wanted to share this morning. We hope it was helpful and maybe even a little enlightening. And let me emphasize that whether or not we get any questions in the next 30 or 60 seconds, please don't hesitate to pick up the phone and call us or email us. If you go to our website, you can get contact information for everyone on the team. You can also find more information about how we think about the economy, how we think about investing. You'll find a number of webinars there, recorded presentations. We think it's a pretty rich source of information and hopefully wisdom. And so with that, I will say thank you for joining us, and have a wonderful day, and we'll see you as the year unfolds.